In late February 2016, a ship called the Asia Vision loaded 3.3 billion cubic feet of liquefied natural gas at a terminal in Cameron Parish, Louisiana, and sailed for Brazil. It was the first LNG cargo ever exported from the continental United States. That sailing date, February 24th, is also the date Russia launched its full-scale invasion of Ukraine in 2022. Whether that is coincidence or symmetry, American LNG and European desperation arrived at the same moment in history, and the consequences of that collision are still playing out. This is not the first time a country sitting on top of enormous gas reserves turned that geology into geopolitical leverage. In September 1964, at a small coastal terminal called Arzew in northwestern Algeria, President Ahmed Ben Bella stood alongside the chairman of the UK Gas Council and opened the world's first LNG export facility. The cargo that left that dock in October of that year, bound for Essex, England, didn't just supply roughly 10% of Britain's gas needs. It proved that a country could liquefy natural gas, load it onto a ship, and move it across an ocean to a buyer who had no other options. Every LNG terminal built since then, including all 8 currently operating in the United States, runs on that same basic premise. Algeria in 1964 was 2 years out of a brutal independence war with France. The Saharan gas fields at Hassi R'Mel had been discovered in 1956 and were considered the 3rd largest natural gas reserve in the world at the time. French companies still controlled the majority of Algerian oil and gas production. The new Algerian government had created Sonatrach, its state energy company, specifically to start reclaiming that control. The Arzew terminal, built for £31 million with UK Gas Council backing, was how Algeria announced itself as a supplier and began building the infrastructure of independence. By 1971, Algeria had gone further. On February 24th of that year, President Houari Boumedienne nationalized all French oil and gas holdings in Algeria, transferring full operational control to Sonatrach. That same year, the first LNG shipment left for the United States, departing October 30th. American LNG import terminals had opened at Everett, Massachusetts, and would follow at Elba Island, Georgia, and Cove Point, Maryland, all built specifically to receive Algerian gas. By 1978 and 1979, the United States was the single largest importer of Algerian LNG. Algeria was building a second major export complex at Skeekta, 500 kilometers east of Algiers, with 3 trains operational by 1973, designed to feed both the European and American markets. The American story inverts this sequence almost exactly. In 2008, the Sabine Pass Terminal in Cameron Parish opened as an import facility, built on the assumption that the United States was running out of domestic gas and would need to buy it from Algeria, Qatar, and other suppliers. That assumption was already wrong by the time the terminal opened. George Mitchell's company had cracked the economics of shale fracturing in the Barnett in 1998. When hurricanes Katrina and Rita destroyed roughly 15% of U.S. gas production in 2005 and drove prices above $15 per million, BTU capital flooded into shale drilling. By 2010, shale gas had gone from 4% of domestic supply to a dominant share. The terminal built to receive foreign gas was sitting idle, facing the wrong direction. That same year, Cheniere Energy announced plans to add liquefaction trains and reverse the flow entirely. The reversal happened at scale. U.S. natural gas production in 2005 was approximately 18.6 trillion cubic feet per year. By 2024, it was 37.7 trillion cubic feet, more than double in under 20 years. Algeria's Arzew terminal, the world's first, produced 1.5 million metric tons per year. The Skikda complex at full capacity produced 7.68 million metric tons. The United States in 2025 exported at an annualized rate of roughly 111 million metric tons. The comparison in absolute volume is less a comparison than a demonstration of how the center of gravity in global gas markets shifted. The structural logic, though, is the same. A country with surplus gas, a desperate importing region, new infrastructure, and a political moment that makes the timing urgent. Britain in 1964 was facing domestic coal supply problems and needed to diversify. Europe in 2022 had just watched Russia cut off roughly 40% of its gas supply, a supply that had run at approximately 45% of total EU imports the year before, and 65% of German imports. When TTF, the Dutch gas benchmark, averaged $40 per million BTU in 2022, after years in the $3 to $4 range, and spiked near $100 in August of that year, European buyers were not negotiating from strength. The price shock from Russian gas weaponization added as much as 2 percentage points to European inflation in 2022 alone, the single largest component of that year's inflation surge. According to research from the European Central Bank, U.S. LNG moved into that gap quickly. In 2021, 34% of American LNG exports went to Europe. In 2022, that share jumped to 69%. By 2023, the United States was supplying 48% of all European LNG imports, the third consecutive year as Europe's top supplier. European regasification capacity expanded by more than a third between 2021 and 2024, with countries rushing to build the floating and onshore infrastructure to receive the cargoes. In the first 11 months of 2025, Europe was receiving 68% of all U.S. LNG exported volumes. Cheniere's CEO Jack Fusco marked the 10th anniversary of that first Asia Vision cargo in February 2026 with this. A decade ago, we started something transformative, producing and exporting LNG at scale from the U.S. Gulf Coast. 10 years and nearly 5,000 cargoes later, we continue to lead the way. The Algerian experience raises a question worth examining before concluding this is a straightforward success. Algeria's decline as a dominant LNG supplier did not come from lack of resources. After Boumedienne died in 1978, the new energy leadership, specifically Minister Belgacem Nabi under President Chadli Benjedid, began pushing for higher LNG prices from all customers. Construction cost overruns and financing problems had wrecked the expected returns on Skikda. Sonatrach needed more revenue per cargo. By the early 1980s, Algerian LNG prices had been pushed above what U.S. buyers could justify against domestic alternatives. The American LNG trade with Algeria collapsed. Export volumes fell approximately 60% in 1980, bottoming at 3.5 billion cubic meters in 1981. The U.S. terminals built to receive Algerian gas sat underutilized for years. Protracted legal disputes followed. Algeria pivoted to pipeline exports, the Trans-Mediterranean line to Italy, completed in 1983, and essentially abandoned the U.S. market it had helped create. The parallel breaks at that point, and it is worth saying so directly. Algeria destroyed its U.S. market through a pricing dispute driven by a state-owned company with existential revenue pressure, operating in an economy where hydrocarbon exports accounted for 90 to 95% of total export earnings. The United States is not Algeria. Cheniere Venture Global and Sempra are private companies operating in a diversified economy, selling on contracts indexed to Henry Hub with destination flexibility built into most agreements. The structural pressure that caused Algeria's overreach does not have a clear American equivalent. What does carry over is the question of dependency. European countries that built structural reliance on Algerian LNG in the 1970s are still buying Algerian gas today. Turkey, France, Italy, Spain remain significant customers. The dependency outlasted the crisis that created it. Europe is now building the same structural dependency on American supply. Regasification terminals are 20 to 30-year assets. Long-term purchase agreements lock in the relationship. EU LNG import capacity is currently on track to reach 29.3 billion cubic feet per day by 2024, against actual demand that some analysts project at roughly a third of that by 2030 if current build rates continue. That is a significant amount of infrastructure oriented toward one supplier. The transit of remaining Russian pipeline gas through Ukraine ended December 31st, 2024, when Ukraine did not renew its agreement with Gazprom. Some Eastern European countries, Hungary, Serbia, Slovakia, Bulgaria, still receive limited Russian gas through Turkstream, but the dominant flow of Russian pipeline gas to Western Europe is gone. Nord Stream 1 and 2 were destroyed by underwater explosions in September 2022 and have not been rebuilt. The European gas market that existed before February 2022 is structurally gone. Algeria proved that the first mover in LNG trade creates patterns that persist for decades. It also proved those patterns can be disrupted by mismanagement, by competing suppliers, and by alternative infrastructure. Qatar entered the LNG market and eventually became the world's dominant supplier. Australia scaled up. Indonesian and Malaysian volumes grew. Algeria's window as an indispensable supplier narrowed and then closed before it could be rebuilt. The United States in 2026 is positioned differently than Algeria in 1979 in scale, in reserve base, in contract structure, and in the political economy of how export decisions get made. The Energy Information Administration projects U.S. LNG capacity will nearly double by 2031 compared to current levels. 8 terminals are operational and more are under construction. The shale gas reserve base is not Algeria's aging Hassi Armel field, but Europe is now the customer. And the historical record shows what that position eventually teaches. When the supplier holds leverage and the customer has no alternative, the dependency runs deep. What the Algerian story cannot answer is whether this time the dependency will be managed well enough on both sides to hold for the decades the infrastructure is designed to last.